The stock market. When opening a company, you sell parts of it in order to fund your company. Stocks, shares, or portions of a corporation that people can buy. When you purchase stock, you can now participate in the activities of an owner. You can cast votes in shareholder meetings that are conducted periodically. The person who holds the most stock of a company is the majority owner and has the most control. There are two types of stock. Common stock, the most prevalent type of stock that companies offer and represents true ownership of the firm. As owners of the corporation, common shareholders own all of the company's profits. After paying all of the business expenses, the board of directors may decide to pay the common shareholders dividends. The board may also choose to keep the money and pay for needed assets instead. If a company files for bankruptcy, they sell the company and use the money to pay the employees, government bills, all creditors, banks, and other loans, and if there's money left over, they pay the common shareholders. Preferred stock. Shareholders of this stock receive their dividends before common shareholders. There is not much of a difference between preferred and common stock. Preferred stock seems to just have a lower chance of losing money because they receive their dividends before the common shareholders. The dividends paid are fixed amounts but come on a more regular basis than for common shareholders. The company is not required to pay preferred shareholders any more than the common ones. Selling stock. A company is able to keep all of their stock, maintaining complete control and profits. Initial public offering, IPO, is the exchange of the sale of stock scheduled by an investment bank. When an IPO is issued, they usually will not sell more than 50% so that they still maintain majority ownership and control. Corporations use the money from selling stock to expand the company. Buying stock. The main reason of buying stock is to make money. Most people use the old rule, buy low, sell high, which is when you buy a stock you think will increase in price at what you consider a low price and then sell it when it increases. Stock prices reflect the opinion of the buyers. Stock exchange. Stock exchange locations are where merchants trade stocks. They originated in Great Britain prior to the 1700s. Great Britain is also where most business initially developed. Between 1800s and 1850 is when organized stock exchange began. Philadelphia Stock Exchange was the first in the U.S. in 1790. This was followed by the New York Stock Exchange in 1792. There are different types of stock exchange markets that all work to help buy and sell stock. The most famous are NASDAQ, National Association of Securities Dealers Automated Quotations, and the NYSE, the New York Stock Exchange. The stock index is a group of stocks that analysts use to determine what trends are occurring. In 1896, Charles Dow created the most well-known index, the Dow Jones Industrial Average, or DJIA. The importance of the stock market is to raise needed funds for a corporation. This also provides a lot of opportunities for average people to be part of a business. Over 57 million households own stock or mutual funds. Mutual funds are privately managed stock portfolios. In 1934, a law created by the government to keep another incident from happening similar to the crash of the stock exchange in 1920 was the Securities and Exchange Commissions, or the SEC. This law states that corporations must provide accurate info to the public at all times. The end.